right, we are live. Hi, everyone. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hi, Katie. It is a beautiful spring day. I am eager to get out this weekend.
Yeah, for sure. Love this weather, so very excited for that. But let's just jump right into all of the latest stock market moves. First up is the bank stocks. What's happening with banks right now, Bob?
Well, they're bouncing today, but it's been pretty awful the last 6 weeks. I mean, many of them are down 40, 50%. All of this happened for one reason. The Federal Reserve very quickly and aggressively raised interest rates. Now, they had to do this because they had to fight inflation. The Federal Reserve has two mandates. One is full employment in keeping the economy going along, primarily jobs, and second is fighting inflation. And they're two jobs. And inflation got out of control for various reasons. And so the way you fight inflation, the traditional way, is to raise interest rates, and that slows the economy down. So they had no choice to do this, but they did it very fast because inflation moved very fast. And this is one of the knock-on effects, what's going on in the bank system. So it started in unusual patches. This is how it always happens. Unusual things happen. 2 or 3 unusual events happen. So you had this Silicon Valley Bank thing. Silicon Valley Bank was a very peculiar bank in Silicon Valley, California. And it primarily didn't have mom and pop deposits. It had companies that were startups, startup tech companies and venture capital funds. And these companies had raised money. And at one point, because interest rates went up, it was harder for them to keep raising money in a series of funding rounds. So they had to draw down their bank accounts to pay everybody because most of these startups are not profitable. So you have a bank that's mostly startups, tech startups, and suddenly they can't raise more money. So they're drawing down their bank accounts literally to pay their people. The bank noticed this, and certain levels, I don't want to get into this rule on deposits, but banks have to keep a certain amount of deposits around just to deal with what's going on. So they have securities behind these deposits that they own. They don't just sit on all of your money. If you give them $100,000, they don't just sit in $100,000 in cash. They go out, they make loans, they buy securities, other things. So the company decided that they were going to sell some securities and raise money to make sure they could deal with the fact that people were drawing down their accounts. Well, so that's the first thing that was unusual. The first thing that was unusual was going out and selling securities. That doesn't usually happen to deal with drawdowns and deposits. That's unusual because people don't usually have those kinds of problems. The second unusual thing that happened is part of the stuff that the bank owned was Treasury bonds. Now, 3-4 years ago, no one would have thought it would be weird for a bank to own 10-year Treasury bonds. They're considered the perfectly safe investment. If you hold them to maturity, you always get your money back, right? The problem is if you have to sell suddenly a product, it's no guarantee you're going to get par for it, what you paid, 100%. In this case, the value of this Treasury bonds dropped because yields went up. So if you're paying 1% on a Treasury bond, a 10-year Treasury bond, nobody's going to give you the full value for 1% when they can turn around and buy the same instrument at 4%. So you're going to discount. The price of that bond's going to go down. So the bank had to sell Treasury bonds at a loss, part of its portfolio. Well, that got everybody's attention. So you have two unusual things happen. You got people drawing down their deposits, and then you have the bank having to turn around and sell assets to deal with the deposits, and some of these assets are being sold at a loss. So this got everyone's attention, and people started creating comments on social media that maybe their deposits are not completely safe, and that created a run on the bank. This is a modern day panic. Years ago, these things happened, but you had to go to the bank, stand in line. Now you can do it with an app. You can move money in an app. That creates almost an instant panic. And this is a new kind of problem that we're facing and that the government's trying to figure out how to deal with it. The simple way to deal with it, of course, is to guarantee everybody's deposits unlimited. Right now, it's $250,000. That would take an act of Congress. Instead, the federal government has implicitly backed everybody's bank account. If you're worried that somehow your bank is going to go under and you're going to lose money if you have more than 250,000 deposited in it, that's the insurance limit, you should not worry. It's not going to happen because the government has said we can't raise the deposit limit without an act of Congress. However, if a bank goes under, we can have emergency measures that will make depositors whole. They have implicitly guaranteed the banks in the United States, even above $250,000, not explicitly, but implicitly. And that should give everybody comfort. Unfortunately, it hasn't for some people. There's additional problems with the banks beyond deposit. One, profitability of the banks is going to go down because they have to pay people more to keep their deposits. You know, even my mother was pulling money out of the banks to buy CDs, which are banks, but they're having to pay. The banks have to pay more. My mother was getting 0.3% in her savings account, and she can get 4% in a CD or 4% buying Treasury bonds. Well, that's going to cost the bank. They're either going to lose the deposits or they're going to pay more for a certificate of deposit. So that's profitability. One is a problem. Number two, most of these big regional banks control commercial real estate. What's that? It's office buildings. It's storage facilities. It's anything that you can think of. It can be apartment buildings too. Well, think of what's going on in the office building business. So the price of these loans have gone up. So I'll give you an example, a commercial real estate loan. They're typically what we call intermediate term, 5 months or so, 5 years or so. That's the duration. And they're right now, a few months ago, they were 4%. Now, a floating rate, these are floating rate loans, 5 years. Now they're maybe 9%. Well, this is a big problem. So it doesn't mean immediately because people have these mortgages, they're, commercial mortgages over a 5-year period that, everything's going to 9% immediately. But if you're rolling over a commercial mortgage that's 5 years old and it's going to roll over the next few months and you were paying 4%, now you're paying 9%. Well, there's two problems. There's a problem with the borrower and a lender. The borrower is going to sit there and say, okay, does my cash flow cover this additional, 9% now instead of 4%? Maybe, maybe not. He might give back the keys to the bank and say, I don't want it. I can't pay it. The lender, the bank, is going to look at the guy and say, I wonder if this guy can afford 9% instead of 4%. So there's a problem for the borrower and the lender. So you see, all of this goes back to the Federal Reserve raising interest rates. That's what's causing the problem. But the Fed didn't have a choice. So the simple way to look at this is that this problem with the banks started as a deposit problem. Now they have to pay more for the depositors. And there's other problems out there, including the higher costs for commercial real estate. And finally, you have issues with bank regulation. They're probably going to be looking at these banks more carefully. So additional supervision might mean less lending for the banks, less profitability. So you get the point. All of this goes back to the Federal Reserve raising rates. It was inevitable to a certain extent, although clearly there are some elements of stupidity and panic here. There is no big commercial bank out there that should be worth 40 or 50% less based on what's going on. Generally, the banking system is quite sound in the United States. And I want to emphasize, nobody should worry at all about the safety of their deposits. The government is not going to allow a bank to go under and say all the depositors can go to hell, even if it's over 250,000. I just don't think that will happen. And the government has not indicated it will happen. I'm sorry about the long-winded answer, but it's a little bit of a complicated question.
Yeah, but I think it's helpful, for people to understand how it all connects, back to the Fed. So definitely something we're going to be continuing to watch in the weeks and months to come. So Bob, next question, earnings season. How has earnings season been going so far?
Well, it's been going really well. And this is one of the reasons the stock market has held up very well. It's been choppy, but it's been choppy on the banking crisis. So generally, last year, remember, there was this whole panic that there was going to be a big recession because the Federal Reserve was raising interest. We did this months ago, right? So everyone said, historically, when the Federal Reserve does something like this, raise rates quickly, it usually creates a recession. So investors know this. This is very well studied historically. So everyone said, oh boy, we're going to have a tough 2023. And the stock market dropped. You know, we dropped, the S&P 500 dropped 25% between January and October of last year. 25%. We ended down 20. And the multiple on the S&P 500, what you're willing, the PE ratio, the PE ratio is what people are willing to pay for a future stream of earnings. So if you have a $10 stock and it makes $1 a year, that PE ratio is 10 divided by 1. But I'm willing to pay $10 for that $1 stream of earnings and the dividends. And sometimes people aren't willing to pay $10. Then it's not worth it to them. They can do something else with their money and get a better return. They can buy Treasury bonds. So maybe you're only going to pay $8 for that $1. See? So the multiple contracted last year as well. So everybody was waiting for this giant recession to happen. And people, the analysts who do the earnings estimates, are kind of reluctant to cut numbers until they see obvious signs that the economy is slowing down. So the earnings didn't drop too much. So everyone's been waiting for this recession. Everyone, it's been endlessly telegraphed. For 6, 7, 8 months, we're waiting for this recession. So far, it hasn't happened. Did you see the numbers today on jobs? Excellent. No job recession, that's for darn sure. So that's the key element right here. So to make this simple, earnings are kind of flattish this year compared to 2022, but that's good. In a recession, earnings will typically drop 10 to 20%. And in really bad recessions, they can drop 30, 40%. In 2008, 2009, forget about it. They dropped close to 50%. So we're flat this year, essentially. Maybe expected to be up 1%, but nobody knows the exact numbers. It's essentially flat, the estimates for 2023 versus 2022. Well, where's this giant recession? It's not showing up in the earnings estimates yet, and it's not showing up in most of the data. There are concerns on the bank issue that it will slow lending down, and that will slow the economy down somewhat. Yes, and that makes perfect sense. But in terms of a serious downturn, So what's happening is the stock market is positioned. This word happens. This word a lot. Positioned for a soft landing. What's a soft landing? Yeah, it's very fuzzy. It means the economy might slow down, but not by too much. And the stock market is reflecting that. The earnings are not dropping, and the multiple, what I talked about, that PE ratio, is very high. It's about 18.5 times. So if you take the S&P 500, it's about 4,100. The dollar estimate for the S&P 500 is, it's about $220 this year. So if you take 4,100 divided by 220, you get something around 18.5. That's the current forward multiple. This is estimates of what's happening ahead of us. So that's pretty rich. Historically, the S&P is somewhere around 17, and during recessions, the multiple can go to 10, 11, 12. You put a multiple on that, you could be at 3,000 on the S&P. So you see what I'm saying here. The earnings season are going very well. Generally, the numbers are coming in much better than expected, and they're not dropping the numbers in the second half of the year. This tells me that the market's still positioned for this legendary soft landing, even though a lot of people don't believe it. A lot of people think it's baloney. A lot of people believe there's some imminent, recession coming that's going to be very serious. And there may be, but it's not being reflected in the stock market right now. And don't think it necessarily means that the stock market's wrong. One of the things I write about in my book, Shut Up and Keep Talking, is one of the maxims I use. Don't yell at the stock market. Don't think you are the lone genius that is determined to come in catastrophe. I can assure you, you're not. You're probably wrong. The stock market is the current betting mechanism for everybody that's out there, and it's the best betting mechanism. It doesn't mean it doesn't go up and down. You see that, but people change their opinions. But right now, there is no serious recession that is priced into the stock market.
Yeah, definitely something that we've been hearing about for a while there, Bob. So we will keep our eyes on it and come back to you for more information. But our next question is about the VIX. So maybe can you explain a little bit about what the VIX is, and then is a low VIX bullish or bearish for stocks?
Yeah, I have never seen so much confusion about an instrument. People throw around this word VIX a lot, but they don't really understand what it means. So the first thing to understand is, what is the VIX? What does it measure? The VIX measures expected volatility 30 days out, and only 30, not 31 or not 90. And what is volatility? Volatility in the VIX is a measure of the put call buying in near-term S&P 500 options. Generally, not always, but generally, when there is panic, there is more put buying, protection in case the market drops. That's put buying. And the VIX will rise on that. This is why it's called the fear index. So generally, but not always, when the VIX is going up fast, it's a sign that more near-term puts are being bought. I want to again emphasize, it's the VIX that we use every day is 30 days out. It does not measure 31. If there's some big event 31 days out, it's not reflected in the VIX. The VIX is not a recession indicator. It's just an indicator of what traders think, how volatile the market will be in the next 30 days. Now, normally, a declining VIX, which we've been seeing recently, VIX trending down, is usually associated with the rising stock market. That's because there's less fear out there. A rapidly rising VIX is usually associated with a declining stock market. And at extremes, it can mean a reversal. What does that mean? The VIX will typically be on one side or the other about 20. So when the VIX is, for example, 16, which is unusual, that's low. That's been around where it was in the last couple of weeks. It's a little higher now. That's often associated with market tops because there's high complacency levels there. When you get the VIX very high, what's high? It depends, but certainly over 30 would get my attention. That's often associated with short-term bottoms. It's hard. Over 30 would be, the market would be very, very volatile. And to get that for days and days in a row would be extremely unusual. That did happen in 2008. But that was an extraordinary circumstance. So understand what this thing is measuring. Only 30 days, and you want to watch the trend. Declining trend generally associated with higher price stocks, increasing trend generally associated with stocks lower, but at extremes, it can indicate bottoms and tops. So that's sort of the way that I look at it. You want to pay attention. I pay attention to the VIX when it's 16, that's unusual. And I pay attention to the VIX when it's over 30, that's unusual.
So Bob, yesterday was a big day at the New York Stock Exchange. We had the Kenvue IPO. Can you tell us a little bit about what it was like on the floor that day? And then also, are we going to get more IPOs after this?
Yeah, I had a great time yesterday because it was like 2007 again. You know, in my book, Shut Up and Keep Talking, I talk about IPOs. Covering IPOs is my favorite thing to do. Of anything, it's my favorite. And the reason it's my favorite is that it's a big party. This is the biggest day for most of the people who are floating the IPO. So yesterday, the Kenvue IPO happened and the CEO of Kenvue came. This is a Johnson & Johnson consumer healthcare spinoff. All the names you know, the Johnson & Johnson's famous consumer name, Band-Aid and Aveeno and Johnson's baby shampoo and Tylenol and Listerine and Neutrogena. So they brought all the products. They were handing out Tylenol and everything on the floor. It was fun. So the CEO comes and they bring a couple hundred people with them. Their family comes, their high-level managerial people, but even a bunch of younger people that were in the office that came. And so they're all standing around. There's a big breakfast upstairs in the boardroom. They come on the floor. They ring the opening bell, and then they start trading. And there's a separate bell right by the trading post. And it's a big day. The president of the NYSE is there. They hand him the first trade certificate. You actually get a certificate that you do as the head of the company. You traditionally make the first trade. So it's just a big day. And you can see all these people, these young people standing there, and they got shares because they work there, and they're looking up at the board. They're waiting for it to trade, and they're looking up says $22, and they're trying, you can see what they're doing. They're trying to figure out their net worth because they're thinking, oh gosh, now let's see, I have 10,000 shares times 22. And they just, it's a great moment. They suddenly realize, oh, I have some money. And in some cases, you have some really big money, really big money in the billions. Not very often, but it does happen. So I was really happy yesterday because we were on the air when the bell rang and went public, and it was very exciting. So there's the good news. We finally got a big IPO. The bad news is it's been horrible the last 2 years. There haven't been any big IPOs. This was the biggest. They raised $3.8 billion, Kenvue. That was the biggest IPO since Rivian, the car company, in November 2021. In a good year, you'll raise 60 billion, 70 billion, all the IPO markets. This year, including this one, we're up to 6 or 7 billion. I mean, think about it. In a good year, you get 60 billion. We've raised, I don't know, 6 or 7 billion this year. It's terrible. Again, it was terrible last year. So there's a whole long list of companies that are trying to go public that the market conditions haven't been able to. The thing about an IPO is the number one, market conditions. If the stock market keeps going down, it's hard. Last year, 20% drop. It was hard for companies to go public. The second is the state of interest rates. Rising interest rates make it tough because a lot of these companies don't have profits. So they have to borrow, and it's tough, and it raises the cost of running the companies. So there's this long list of companies that are out there, and you know most of them. You know, Reddit, remember Reddit? They filed to go public in December 2021. They're still not public. Instacart, you know, the delivery company, they filed in a year ago, May of 2022. Still not public. They're getting old. Stripe, another company that's been, you know, interested in going public. Impossible Foods, StubHub, Fanatics, the sports company, Flipkart. They're all rumored to be interested in going public. They all want to go public, but they're kind of stuck. Market conditions, as you call it. So the hope here is maybe we can get things going if the market stabilizes. We had a report last week of ARM, a big semiconductor company, is going to go public. They filed to go public, but that doesn't mean they will. You can, you know, announce to the world you've applied to the SEC to go public, but, you know, and the SEC could say, fine, you can go public, but they may not want to. This happened with Reddit and Instacart. So I'm hopeful that if the economy stabilizes and we don't have a recession, a serious recession, we'll get more IPOs later this year. But I don't know for sure. It's still very, very iffy. But yesterday was a good start.
Yeah, it definitely seemed like a really exciting day for all of you down there. So Bob, something that you touched on a little bit earlier, but just to kind of talk about it again, will there be a recession in the near future? And then going off of that, what is best to own if we do have a recession? Yeah,
first off, nobody knows what a recession is. It's actually very difficult to define it. It used to be 2 consecutive quarters of negative GDP growth. Nobody uses that anymore. The actual definition is determined by the National Bureau of Economic Research. They determine when a recession occurs, which they call a significant slowdown in the economy. And it always is declared after the recession happens. So we don't actually know we're in it or not. And let's put it this way, stop worrying about it. You know, there's a better joke that I always used to use. This goes back, 50 years. A recession is when your neighbor loses his job. A depression is when you lose your job. So look, that's the way most people look at the world. I wouldn't worry about trying to define what a recession is. My current best guess is we will have a slowdown, but it will be fairly mild because I tend to go along with what the market is doing at this particular time. And that makes some sense to me, but it could get worse or it could get better. We don't know. It's just a bit of a crapshoot right now. What you should worry about is where your portfolio sits. I have spoken many times about this. You should not be trying to trade or time the market. Why? Because you will lose. The academic literature is overwhelming on this, that you cannot pick stocks or time stocks. I've written in the book what I own. I own index funds. I've owned, my largest holding is the S&P 500. I've owned it for ages and ages. And what I do with it is nothing. I keep adding to it. I don't think that I can time the market. The only thing that I've done significant in the last few years is I used to have a little bit of money in cash, 5%. There's no reason to have money in cash when you can get 4% from a money market mutual fund. So I have that cash that I normally have sitting, that's just cash, I have in a money market mutual fund. It makes 4% or something. That makes sense. That's a good move to make in this environment. Other than that, I own the same stuff. I own a broad index fund. I own a small cap fund. I own an international fund. And no, I do not try to beat the market or time the market. And in the book, I describe why I don't think you should be doing that either. You should understand, most importantly, your risk tolerance. How much money can you afford to risk and still sleep at night? And if you're young, the answer is you should be able to afford a higher degree of risk. That's what everyone talks about. All the professionals say that. You should not worry about whether the market goes up or down. What you ought to do is examine your beliefs. Here is the primary belief you must have. You must believe in the United States economy. You must believe in the future. If you don't, maybe you shouldn't be in stocks. I personally believe that the history of the stock market in the United States is it goes up on average about 10% a year. That doesn't do that every year. Some years it goes up 20%. Some years it's down. Last year it was. But over long periods, it goes up about 10%. And you want to play the long game, the long average. Stay long. Investing generally is boring. It is not gambling. Do not think that you're sitting in a bar with your boyfriend or girlfriend and you got FanDuel on one phone and you've got an app, Vanguard or something else, Fidelity app to trade stocks. And you think they're the same thing. Should I bet on the 76ers game or the Giants game, or should I bet on Apple? And you think they're the same thing. They're not. There is an illusion, what we call the gamification of trading. Trading stocks looks like trading or betting on sports. It's not. People say, oh, the stock market's a casino. Why? It's the same thing. That is wrong. The stock market is not a casino. The stock market is the opposite of a casino. Why? In a casino, if you keep playing the game, you're guaranteed to lose. Walk into a casino, play roulette, and mathematically, they know exactly how long it's going to take for you to lose money. You might hit a few times, but the house must win. Otherwise, the house won't exist. It has to win. It's set to win. Otherwise, they go away. It's just mathematics. Now, let's contrast this to the stock market. You go into the stock market, you stay there, you buy a bunch of stuff, and you just sit there. Mathematically, we know over time, you win. You do not lose over time. You win. You see, it's the opposite of a casino. Casino, keep standing there, keep playing, you lose. In the stock market, stand there long periods of time, you win. So it's not a casino. And everybody just needs to sort of understand that and understand your brain chemistry and what it does, that pleasure and reward center. You have to turn it off when it comes to stock investing. If you really like the idea of gambling with stocks, take 10% of your money and go knock yourself out. But keep the rest in index funds and don't do anything. And I'm telling you right now, if you're honest with yourself, you're going to find you're not going to beat the market. You're not. A lot of people are not honest with themselves. A lot of people lie to themselves. They don't include the amount of money it costs to actually stay invested, the amount of money it costs to trade, the time that they spend doing this. People are terrible at understanding things. Get a little wiser on that front and confine the gambling to sports and a tiny part of the stock market.
Yeah, that's great and very helpful to differentiate those two. So Bob, our last question, how can we analyze news that impacts the stock market?
Well, it's really hard to do that. That's my point. You think you can, here's the question you should ask yourself. Do you have an information advantage over anybody? You're kidding yourself if you think you do. You don't. The smartest minds on Wall Street are still trying to compete against each other. They don't. It's almost impossible to generate alpha trading stocks today. Alpha means outperformance, risk-adjusted outperformance. It's almost impossible. Why? Because information is so evenly distributed. Even amongst professionals, there's very little informational advantage that anyone has. So look at the jobs report today. It was much stronger than expected, which is great news. I mean, the job market's still strong. Isn't that good news? I think it's good news. And yet there was a brief period in the market, the futures, where it actually went down. Why? Well, you know, the Fed's going to keep hiking because the economy is still strong. So this is the bad news is good news, or the good news is bad news story here. Today, we're up and we're having a good rally, but there are other factors at work here. Number one, bank stocks are ridiculously oversold. JP Morgan actually upgraded some bank stocks today, believe it or not, because they were so oversold. The market was oversold. So there's other factors about why the market might be up today. In fact, on any given day, it's fairly difficult to figure out why the market's up and down. It's actually not that easy, believe it or not. It's a story for another day. The bottom line here is analyzing news is something I do for a living. And after sitting here for 33 years, I'm still concluding that there are days when it's a little difficult to figure out why the market is in such a way. More buyers than sellers sounds stupid, but it's actually a very good way to look at the market. That's generally what's going on. But again, having a plan, understanding your risk tolerance, understanding the value of staying long, and understanding that market timing doesn't work is the absolute key. It doesn't mean you shouldn't get up and read the paper and understand the news flow. I do, but it also means that you have to have a limit. You have to understand your own limits of understanding on this, and it's better for you to be a lot more humble. I'm a lot more humble now than I was 25 years ago, when I thought I could find the perfect traders who would explain everything to me. There's a chapter in my book called The Wizards of Oz, where I detail an attempt over 20, well, not 20, but 7, 8 years of just constantly going out with traders, looking for the perfect traders, the perfect ones that I'd have to call, and they're the only ones I'd ever have to talk to because they're so brilliant. And it doesn't exist. It was enough, but I go explain what I actually learned talking to these traders. And they did have some wisdom. It wasn't a stupid, fruitless attempt. I spent a lot of money on barbells, I can tell you that. But it's better to be a little humble and recognize the limits of your understanding.
Well, that's something we can definitely dive into more on another week of Market Matters. Thanks, Bob, for answering all of the questions.
Hey, these were great questions. I know I got a little long-winded on the bank answer, but it's complicated. And again, everybody, you guys know what's going on. You ask great questions, so stay long and be happy.
Yeah, for sure. Well, thanks, Bob, and we'll talk to you again in another couple of weeks.
All right. Take care, everybody.